All right, welcome to Talk Tickers. Today we're diving into a real Wall Street head-scratcher, Papa John's Q3 earnings. The company missed on just about every key metric, and they even slashed their forecast for the year. And yet, the stock rallied. So what in the world is going on? Let's break it down.
So here it is, the big question of the day. Papa John's misses its numbers, cuts its guidance, and the stock rallies almost 4%? I mean, on the surface, that just doesn't add up, right? The numbers looked pretty messy. But the market's reaction, well, that tells a much more complicated story. And to really get it, you've got to rewind the tape a few days before the announcement. Okay, so let's get into our first section, the surprising stock rebound. We're going to unpack this paradox. Because really, the key to understanding this whole thing isn't just in the earnings report itself. It's about the storm of bad news that was already swirling around the stock. Okay, now this timeline really lays it all out. Just look at this. On November 4th, the stock gets absolutely hammered, down about 10%, because the private equity firm Apollo walks away from its buyout offer. Ouch. The next day, it drops another 5%. So in just a few days, the stock's already down around 20%. Then, on November 6th, before the market even opens, the week earnings report comes out and shares dip again. But then, look what happens. The stock completely reverses course and closes the day up almost 4% on some really heavy trading volume. What does that tell you? It tells you that by the time the earnings hit, all the bad news was pretty much priced in. The report was bad, for sure, but it wasn't the total catastrophe everyone was bracing for. It was a classic, not as horrible as we feared, relief rally. All right, let's move on. Section 2, dissecting the earnings miss. We're going to take a closer look at the actual numbers here, because these are the figures that caused that initial dip before the market opened, and they really paint a picture of a business that's, well, it's struggling, especially here in North America. So here's the big one, the headline miss that everyone saw first. Adjusted earnings per share, or EPS, came in at just 32 cents. And what was the Wall Street consensus? 40 cents. That is a huge 20% miss. You can bet that's the number that set off all the alarms initially. And it wasn't just earnings. The top line, the revenue, also fell short. They brought in about $508 million, but that missed estimates by around $15 million. That's about a 3% miss. So you're seeing pressure from both ends, on sales and on profits. Okay, and this number right here, this is a big red flag. A negative 3% growth in North American comparable sales. That means their core home market is actually shrinking. That's a serious problem, especially when we look at how their rivals are doing. And management was pretty clear on the call. They said their lower income customers are the ones really pulling back. So when your domestic sales slump like that, it's going to hit your profitability, right? And it did. Adjusted EBITDA fell 4% from last year. Now, why? Well, it's a combination of that sales weakness we just talked about, and the fact that they're spending more on marketing to try and fix it. Their strength overseas helped a little, but not enough to offset the problems at home. This brings us to our next section, a tale of two pizzas. Because when you listen to the earnings call, that's exactly what it sounds like. You've got North America on one side and international on the other, and they're two completely different stories. I mean, this slide just lays it out perfectly. On the left, you've got North America. Comps down 3%. Why? Because folks are feeling the pinch. They're trading down from a large to a medium pizza. They're skipping the wings and the sides. But then you look to the right at the international business, and it's on fire. Comps up a whopping 7%. That's their fourth straight quarter of positive growth. The international segment is literally the engine keeping this whole company moving forward right now. And if you want to see just how tough things are at home, check this out. Papa John's is down 3%. Meanwhile, Domino's is up over 5%, and even McDonald's is up almost 2.5%. What this tells us is that this isn't just a weak consumer problem. Papa John's is actively losing market share to its biggest competitors in the U.S. That's a tough pill to swallow. Okay, so things are tough in North America. We get it. The big question is, what are they going to do about it? Let's get into Section 4, the turnaround playbook. Management laid out a pretty clear 3-part strategy to try and right the ship. And here's the game plan. It's really a 3-pronged attack. First, get aggressive on cost savings. Second, speed up the process of refranchising, which means selling off company-owned stores. And third, sharpen up their value message and innovate with new products. So let's start with the cost savings. They're not messing around here. They've identified over $25 million in G&A savings and another $50 million they're targeting in their supply chain. The big goal? Add about 100 basis points, that's a full percentage point, to their restaurant-level margins.
That's absolutely crucial for helping out their franchisees, who are the ones feeling the most pressure.
Next up is refranchising, and we have a great quote here from the CEO, Todd Penegor. He says they expect to reduce company ownership down to a mid-single-digit %. So what does that mean? They're speeding up their plan to sell corporate-owned stores to franchisees. The big idea is to become what's called an asset-light company. It's less risky, requires less capital, and lets them focus on collecting those nice, steady royalty checks from their franchise partners.
And finally, number 3, they're hitting back on the marketing front. To win back those customers who are watching every penny, they're pushing things like 50% off carryout deals. At the same time, they're trying to create some excitement with new stuff like the Grandpapa Pizza. It's what you call a barbell strategy. You're hitting both ends of the market, the value seekers and the people looking for something new and exciting. All right, so that's the plan. Now, for the most important part, what does this all mean for the stock going forward? Let's get to our final section, the next call, our verdict. First things first, let's look at the official guidance. And while they really took a red pen to their forecast for the full year, you can see they cut their expectations pretty much across the board for system-wide sales, for North America, and for EBITDA. The only bright spot? They actually raised their guidance for the international business, which just hammers home that tale of two pizza story we've been talking about. So when you look ahead, you can see the stock is caught in this massive tug of war. On one side, you've got the very real execution risk. Can they actually turn the North American business around? That's a huge question mark. But pulling in the other direction, you've got some powerful support. There's M&A optionality, meaning another company could always swoop in with a bid. And you've got a really solid dividend yield of about 4.5%, which provides a nice safety net for investors. So what's our prediction? Honestly, we think Q4 is going to look a lot like Q3. You'll see continued pressure in North America, with that amazing international growth helping to bail them out. Because of that, we think the stock is going to stay pretty much range-bound. It's not going anywhere fast until there's clear, undeniable proof that their turnaround plan for the US is actually starting to work. And that brings us to our official rating. We're initiating coverage on Papa John's with a market perform. Look, there's definitely potential upside here from the cost savings and the M&A chatter, but that's perfectly balanced out by the huge headwinds and intense competition they're facing in the US. The bull case and the bear case are basically canceling each other out for now. And as always, please remember, this is not financial advice.